18 trillion US dollars. That is one widely cited estimate reported by the Wall Street Journal of the household wealth erased during China's property collapse since 2021. Now, whether the exact estimate is 15 trillion, 18 trillion, or something else isn't really the most important point. The important point is this. For decades, millions of people believe one thing about Chinese property. Property may correct, but eventually it comes back. And then suddenly that assumption stopped working. So if you're buying property in Singapore or Malaysia, I don't think the lesson is China crash, therefore we're going to crash. That's far too simplistic. The more useful question is, what actually caused China's property machine to break, and do any of those conditions exist here? China's property downturn has now lasted roughly 5 years. But I want to be very precise here because the latest numbers are actually more interesting than the headlines. In June 2026, China's nationwide new home prices were still down about 0.1% month-on-month and 3.3% year-on-year. But the four first-tier cities actually recorded a small 0.1% month-on-month increase in new home prices. So China isn't simply falling everywhere anymore. There are signs of stabilization. But there is still no convincing nationwide recovery. And that distinction matters. Because this isn't just a normal property correction. China had a highly leveraged development model. Evergrande, once one of China's biggest developers, collapsed with more than 300 billion US dollars in liabilities after defaulting in 2021. And that's where leverage becomes fascinating. Debt isn't necessarily dangerous when sales are growing. Developers borrow, they buy land, they launch projects, buyers pay deposits. Developers recycle that money into the next project, and the machine keeps moving until sales slow. Then suddenly, the same leverage that accelerated growth starts accelerating the decline. And something even more damaging happens. Buyers stop asking, how much will this property appreciate? They start asking, will my property even be completed? That's not just a price problem. That's a confidence problem. And confidence is much harder to rebuild. Then add demographics. China's population fell by another 3.39 million people in 2025, ending the year at approximately 1.405 billion. So the market is now working through a very different equation. Slower household formation, a shrinking population, large existing housing inventories, and buyers who have learned that prices don't automatically recover just because they fell. Now let's cross over to Malaysia. Malaysia is a completely different story. Malaysia does not have China's nationwide property collapse. Its banking system hasn't experienced an Evergrande-style event. Its developers aren't collectively imploding, and its property market continues to transact. But Malaysia gives us another very useful lesson. You can have a functioning property market. You can have growing infrastructure. You can have economic development and still have too many properties in particular segments and locations. Here's a number worth paying attention to. According to Malaysia's National Property Information Centre (NAPIC), Malaysia ended 2025 with 30,471 completed but unsold residential units. 1 year earlier, 23,149. That's a 31.6% increase in 1 year. And those completed unsold units were worth approximately 17.73 billion ringgit. But here's something even more interesting. Almost 47% of that completed residential overhang consisted of condominiums and apartments. Now, does that mean Malaysian property is collapsing? No. And I wouldn't use these figures to make that argument. What it tells us is something much more useful. Demand can be healthy at the national level, while individual projects still suffer from oversupply. Because there isn't one Malaysian property market. A landed home in an established neighborhood isn't the same asset as a 1,000-unit condominium. Kuala Lumpur isn't Johor. And even within Johor, A property benefiting directly from infrastructure and genuine owner-occupier demand may behave very differently from an investor-heavy high-rise surrounded by competing projects. This is where buyers sometimes make a mistake. They hear, Johor is booming, or the RTS is coming, or this whole area is transforming. All of those things can be true, but it does not automatically mean every property in the area becomes a good investment, because economic growth doesn't eliminate supply, and infrastructure doesn't eliminate competition. Then we come to Singapore. Singapore is different again. People often explain Singapore property with one sentence: we're a small island, land is scarce. True, but that's an incomplete investment thesis. Because here's something many people may not realize. Singapore is actually increasing private housing supply quite aggressively right now. For 2026, the government land sales confirmed list will supply 9,320 private residential units. URA says that's more than 50% above the annual average confirmed list supply over the previous 10 years. And as of the latest Q2 2026 data, approximately 60,600 private homes, including executive condominiums, are expected to be completed over the coming years. But here's the important part. Singapore isn't succeeding simply because there isn't enough supply. Singapore's distinction is that supply is actively managed. Land release can be adjusted. Credit conditions are regulated. Loan-to-value limits exist. Total debt servicing ratio restricts excessive borrowing. Stamp duties can restrain speculative or foreign demand. And when policymakers believe more homes are needed, they can release more land. That's very different from allowing supply and leverage to expand indefinitely and trying to solve the consequences later. And the latest Singapore data shows something else. In Q2 2026, Singapore private residential prices increased 0.5% overall. But look underneath that headline. Non-landed prices in the rest of Central Region fell 1.2%. Outside Central Region, down 0.1%. Core Central Region, up 1.8%. Same country, same quarter, 3 different outcomes, which tells us something incredibly important. There isn't one Singapore property market either. And that's where I think buyers sometimes become too comfortable with national statistics. They say Singapore property went up. Okay, which property, which location, which size, which tenure, which buyer demographic, which competing supply, which entry price? Because ultimately, you don't buy the Singapore Property Price Index. You buy one unit. So, what does China actually teach us? China does not tell us Singapore is about to collapse. Malaysia does not tell us oversupply automatically destroys a market. And Singapore does not tell us property prices can never fall. The real lesson is this. Never confuse something that happened repeatedly in the past with something that must happen forever. Chinese property buyers had 20 years of evidence telling them property eventually goes higher, until it didn't. In Malaysia, investors can look at infrastructure development and assume development means appreciation, not necessarily. And in Singapore, we sometimes hear land is limited, population will grow, government won't allow property prices to collapse. Singapore property always goes up eventually. Now, some of those arguments may contain truth, but they're still not enough. Because they are macro narratives, they are not an analysis of the property you're actually buying. Here are the questions I would ask instead. Don't ask me, PK, will Singapore property go up? That's almost the wrong question. Ask, what exactly am I buying? How scarce is this property type? How much competing supply exists now? What's coming 5 years from now? Who is the next buyer for this unit? Am I buying something predominantly investors want? or something genuine homeowners want? How does the price compare with alternatives? And finally, what assumption must remain true for my investment thesis to work? Because that's where property mistakes usually begin. Not with the things we know are uncertain, but with the assumptions we stop questioning. So, in conclusion, China, Malaysia, Singapore, three property markets, three very different structures, and three very different lessons. China shows what can happen when leverage, oversupply, demographics, and confidence all turn against a market. Malaysia shows why economic growth doesn't automatically rescue the wrong property from excess supply. And Singapore demonstrates the advantages of a more tightly managed housing, credit, and land supply system. But it still doesn't mean every property is automatically a good investment. Because ultimately, you're not buying Singapore, you're not buying GDP, and you're not buying a government policy. You're buying one property at one price against many alternatives. And that's why at bigger.sg, instead of simply asking whether the market will go up, we look at the property, the entry price, the competing supply, the buyer pool, the scarcity, the alternatives, and your eventual exit. Because the question isn't, is property a good investment? The question is this property at this price a good investment? Those two questions sound almost identical, but financially, they can lead to completely different outcomes. I'm PK So from bigger.sg. I'll see you in the next one.